Green finance introduction. Whether you've seen or been personally impacted by Extinction Rebellion or school strike climate change protests, whether you've watched David Attenborough's BBC or Netflix programmes, or whether you've heard or read the Bank of England Governors Mark Carney or other senior central bankers and financial regulators recently, it's clear that tackling climate change has gained critical prominence in recent months. Natural causes and human activities both drive climate change. But the overwhelming scientific consensus is that human activity has had and continues to have a significant impact. The Intergovernmental Panel on Climate Change's special report, published in October 2018, contains the most comprehensive and up-to-date assessment of the science relating to global warming. It is quite clear, stating that human activities are estimated to have caused approximately 1 degree of global warming above pre-industrial levels. Global warming is likely to reach 1.5 degrees Celsius between 2030 and 2052 if it continues to increase at the current rate. The effects of 1 degree global warming are already visible and include more frequent and more severe extreme weather events, sea level rises and increased flooding, melting glaciers, sea ice and the Greenland and Antarctic ice sheets, loss of biodiversity, and displacement and migration of communities. Limiting global warming to 1.5 degrees Celsius requires reducing emissions of carbon dioxide, one of the main greenhouse gases, by some 45% by 2030, relative to 2010 levels. This seems to be highly unlikely at the current rate of progress. If global warming exceeds 2 degrees Celsius, factors such as melting sea ice and the release of methane currently captured in permafrost could lead to a tipping point of rapid and irreversible climate change with profound environmental and social consequences. That's the bad news. The good news is that we can limit the extent and the effects of climate change. We already have the technologies we need for a transition to a sustainable low-carbon world. Renewable energy, clean transport, energy-efficient buildings, sustainable agriculture, aquaculture and forestry, for example, to limit greenhouse gas emissions. This is known as climate change mitigation. And we are already supporting communities most impacted by the effects of climate change, improving their resilience to rising sea levels and extreme weather events, for example. This is known as climate change adaptation. The even better news is that our financial services sector has a key role to play in supporting that transition. It requires very substantial capital. Estimates of the investment needed vary, but a figure of $6 trillion per year for the next 20 years is a generally accepted figure. Green finance. The scale of investment required means that public funds alone will not be sufficient. The financial sector, therefore, has a key role to play in mobilising and directing private capital to support the transition. It is estimated that up to 80% of the funds required will need to come from private sources. And it is banks, investment funds and other financial institutions that, by doing what we do best, can connect private capital and savings with the investments and the projects needed for the transition to a sustainable, low-carbon world. This is one key aspect of green finance. There's another important aspect. The financial services sector is also impacted by the environment, particularly through climate change, creating significant climate-related financial risks. The World Economic Forum's 2019 Global Risks Report lists extreme weather, environmental policy failure, and natural disasters in its top 5 global risks. For the financial services sector, perhaps the key risk is asset impairment and stranded assets. That is, the risk of a significant or total loss of economic value of an asset, such as an investment in an oil company, due to an abrupt change to a low-carbon world. The potential impacts are so significant that regulators consider an abrupt transition as a systemic threat to the stability of the financial sector. The Bank of England, for instance, has said that as much as $20 trillion of assets could be stranded by climate change. Think of the impact on your institution's portfolio or your personal pension. What proportion is currently invested in high-carbon fossil fuel-linked assets? Do you know, or could you find out? Identifying, measuring and disclosing climate-related financial risks is another key aspect of green finance and a major focus for regulators, policymakers and financial institutions led by the Task Force on Climate-Related Financial Disclosures, the TCFD. Green finance, then, is finance that supports the transition to a sustainable, low-carbon world, or helps financial institutions and clients manage climate-related and other environmental risks. Ideally, of course, green finance is both of these. the growing importance of green finance. Although still a relatively small proportion of the financial markets overall, green finance is growing rapidly. Driven by policy and regulatory incentives and commercial opportunities, it will continue to grow substantially. At the global level, the Paris Agreement on Climate Change, which has legally binding force, requires countries to make flows of finance consistent with low greenhouse gas emissions and climate-resilient development. And I think it's very telling that the key global climate change agreement has, in one of its three main objectives, singled out the critical role of finance. We are already seeing policymakers and regulators respond, with the European Union considering green supporting factors for capital allocation and central banks introducing climate-related risks into stress test scenarios, for example. Regulatory frameworks, standards and guidance are rapidly developing, including the TCFD just mentioned, the UN Principles for Responsible Banking, the Green Bond and Green Loan Principles, and the Climate Bond Standard, to name but a few. And markets are already taking advantage of some of the opportunities presented by green finance. To give just three examples. The green bond market grew to approximately $167 billion by 2018, issuers including sovereigns, government agencies, international organisations, cities, towns, municipalities, companies, and a wide range of financial institutions. Green mortgages and an ever-increasing range of green retail banking, retail investment and insurance products are now available worldwide, and sustainable, responsible or ethical investing now accounts for some $23 trillion of assets under management globally. That's around a quarter of the total. What does green finance mean in practice? Actually, the financial principles, processes and procedures underpinning green finance are similar to those of finance in general. The basics of credit analysis, risk assessment, due diligence, investment decision-making and so on still apply. In addition to measuring and reporting the financial returns of investments, in green finance we also measure and report the climate change mitigation and adaptation impacts of our investments. This is not an area that most finance professionals will have expertise in, and so obtaining expert external review, verification and certification of the environmental impacts and outcomes of investments is an important aspect of green finance. Doing so means we can ensure the integrity of the growing green finance market and avoid greenwashing. That is, making false or misleading claims about environmental impacts, either deliberately or inadvertently. What is the future of green finance? Green finance addresses the world's greatest collective challenge, tackling climate change. It is a key enabler of the transition to a sustainable, low-carbon world. It offers very significant commercial and investment opportunities for financial services. There is a strong economic case for green finance. But there is an even more compelling moral case. Green finance is an opportunity for our profession to demonstrate our positive social purpose. Banks and bankers really can play key roles in saving the world. The more we can mainstream green finance, the more we can reconnect banking and society.